Moog Inc. just reported a massive top and bottom line beat for their Q3 2026 earnings, just completely blowing past consensus estimates.
Oh, yeah, it was a total blowout.
Right. So revenue came in at $1.117 billion, and I mean, that marks a 15% year-over-year increase. But the number that immediately triggers alarm bells, and the real reason the stock is reacting so aggressively today, is the bottom line.
The EPS number is just wild.
Yeah. Adjusted diluted net earnings per share landed at $3.72. That is a massive 60% jump from the $2.33 they reported back in Q3 of 2025.
And, they aren't just riding this one good quarter.
Exactly. They actually raised their fiscal year 2026 guidance pretty significantly. The total sales forecast was bumped up by $50 million, landing at $4.385 billion, and they raised their adjusted EPS guidance by a full $1.05, bringing it to $11.65.
Which is just a huge vote of confidence from management.
It really is. So if you are a retail investor holding this stock or, just watching it from the sidelines, our mission for today's deep dive is to really tear into the footnotes of this record quarter. We are going to separate the core operational strength from, well, the one-time accounting tailwinds.
Because there's a lot of noise in those numbers.
Totally. We'll also analyze the segment-by-segment performance to figure out exactly who is buying all this hardware and critically evaluate the underlying risks that management flagged.
Right, because when you see a 60% jump in earnings per share in a heavy manufacturing and aerospace business, it really demands immediate scrutiny.
It's not a software company.
Exactly. I mean, businesses with complex supply chains and heavy fixed costs, they do not suddenly become 60% more profitable overnight purely through, operational efficiency.
Right. There has to be something else going on.
Yeah. We have to look closely at the margin bridge. The breakdown of how they got from last year's profit margin to this year's, just to understand exactly how much of this was organic growth versus external one-time factors.
Let's start right there, actually, because if you are valuing this company based on a 3.72 EPS, you really need to know if that number is real or just, an accounting illusion.
Right.
Looking at Moog's adjusted operating margin, it expanded by 280 basis points year over year, landing at 16.4%. And for anyone outside of Wall Street, 280 basis points means a 2.8% improvement.
Which is massive in this sector.
Right. In software, maybe that's negligible, but in aerospace manufacturing, gaining nearly 3% in operating margin is a huge leap in profitability.
Yeah.
But, reading through the earnings release, it seems like that 2.8% didn't primarily come from selling more hardware.
It didn't. And that is why the margin bridge is the most revealing piece of data in this entire report.
Let's break it down.
Sure. So let's isolate the core business performance first. Pure operational execution, meaning they sold more units, increased their prices, ran their factories more efficiently. That contributed 80 basis points to that margin expansion.
Okay, so that translates to a 0.8% organic improvement.
Exactly. And that is a very healthy, sustainable metric. But, it obviously falls far short of the 280 basis points they reported.
Right, so if the core business generated 80 basis points, where on earth is the other 200 coming from?
A single massive tariff refund.
Wait, really? Just one refund?
Yep. The bulk of the margin expansion, a full 270 basis points, was derived from $30 million in International Emergency Economic Powers Act, or IEEPA, tariff refund claims.
Wow.
Yeah, Moog essentially just got a massive check back from the government for tariffs they had previously paid on imported components.
So hold on, if we do the math here, 80 basis points from the core business plus 270 basis points in the tariff refund, that gives us 350 basis points of total expansion. Why did the final reported number land at 280?
Well, because you have to factor in year-over-year comparisons. That 350 basis point gain was partially offset by a 70 basis point drag related to an asset sale.
Oh, from last year.
Right. Last year, in Q3 2025, Moog sold off a non-core product line, which gave them a temporary margin boost in that specific quarter.
Got it.
So because they didn't have a similar asset sale to prop up the numbers this year, it acts as a year-over-year headwind. The math works out perfectly. 350 basis points of gains minus the 70 basis point headwind brings you right to the 280 basis points of net expansion.
Okay, but this brings up a major question regarding the quality of these earnings.
Mm-hmm.
I kind of want to push back on the enthusiasm surrounding this beat.
Sure, that's fair.
If we strip out that $30 million tariff refund, the 60% EPS jump looks drastically different. As an investor, shouldn't I view this refund the exact same way I'd view like a one-time legal settlement.
Yeah, absolutely.
I mean, it's great for the cash balance today, but it's like finding a $20 bill in your winter coat. It tells me absolutely nothing about Moog's future earning power.
I wouldn't dismiss it entirely, but yeah, your skepticism is totally warranted. You absolutely cannot build a long-term investment thesis on sporadic government refunds.
Right.
Wall Street analysts are definitely going to model that $30 million out of their forward projections. However, the reason the stock is being rewarded today is because of that underlying 80 basis points of core expansion.
So the core is actually strong.
Exactly. While the tariff refund was the loud, headline-grabbing number that distorted the bottom line, the core engine of the business is genuinely running hotter and more efficiently. We are seeing real pricing power.
But the distortion goes even deeper when we look at the tax line, doesn't it?
Oh, yeah, the tax stuff is fascinating this quarter.
Because we've been discussing the 3.72 adjusted EPS, but their GAAP reported EPS, the official accounting number, was actually 4.74.
Right.
Usually in these earnings reports, we see management adjusting earnings upward to hide bad news. But here, Moog adjusted their earnings downward by over $1.
It is a really strong signal of transparent accounting, honestly. The 4.74 reported EPS was heavily inflated by two structural tax events that really have nothing to do with Q3 operations.
Right, I saw that.
First, they finally recognized a $35 million U.S. federal research tax credit that actually relates to prior years of research and development.
Wow.
And second, they recorded an $8 million discrete tax benefit stemming from legal entity simplification initiatives.
So they basically reorganized their corporate structure globally to be more tax efficient, reaping an $8 million benefit from that, and then successfully claimed a $35 million R&D credit from previous years.
Correct. But those are retroactive balance sheet adjustments, right? They do not reflect the current demand for Moog's products today.
Yeah, that makes sense.
So by backing those out, alongside $7 million in restructuring charges, management is attempting to give you that 3.72 figure as a much cleaner reflection of what the business actually earned from its operations.
Okay, let's move to the segments. Because if the core business is driving 80 basis points of that margin expansion, we need to locate exactly where that organic demand is coming from.
Let's do it.
Moog operates 4 main segments, and the top line absolute dollars were led by space and defense, which brought in $336 million in sales, and that represents a 17% year-over-year increase.
And that 17% growth is not a fluke. It is being driven by sustained, broad-based defense demand. Specifically, management highlighted missile controls and space vehicle.
Right, which makes sense given everything going on globally.
Exactly. When you look at the current geopolitical climate, global defense budgets are heavily prioritizing the replenishment of advanced munitions. And we are not talking about basic ballistics here.
Right now.
We're talking about highly engineered, precision-guided missile systems that rely heavily on Moog's specialized actuation and control hardware just to function.
And the margins in space and defense expanded by 150 basis points to 15.7%. Though, reading the footnotes, they did note that this margin improvement was aided by those tariff refunds.
Yeah, the tariffs touch almost everything.
Right, and it was actually partially offset by what they call operational readiness investments. So they were basically having to spend money to ensure their supply chain and factories can actually handle this influx of defense orders.
That is the classic double-edged sword of defense contracting. I mean, the demand signal is incredibly strong right now. But scaling up heavy manufacturing to meet specialized military specs requires significant upfront capital.
For sure. So let's transition to military aircraft, which reported $245 million in sales, up 9%.
Solid growth.
Yeah, and that growth was driven by strong aftermarket activity, which just means selling replacement parts and services for existing fleets, and increased activity on the MV-75 Tiltrotor program. But the real story here seems to be the margins.
The margins are wild here.
Yeah, they jumped a massive 290 basis points to 14.7%. But when I look at the prior year's data, there's a serious statistical mirage happening here, isn't there?
A mirage is the exact right way to frame it.
Yeah.
A significant portion of that 290 basis point expansion in military aircraft is simply due to an incredibly easy year-over-year comparison.
Because of a write-down.
Right.
Yeah.
In Q3 of 2025, Moog took a massive 360 basis point charge against their margins because they had to completely terminate a specific product development effort.
Right, and this is a crucial mechanism for retail investors to understand about defense stocks.
Wow.
Companies sink millions into developing new tech for the Pentagon.
Oh, yeah. Tons of R&D.
And if the government abruptly pivots or cancels the program,
Yeah.
the company just takes a massive write-down. Because Moog took that hit last year and didn't have a similar disaster this year, the margin naturally springs back up.
Exactly.
So if you adjust for that historical charge, the military aircraft margin actually contracted, didn't it?
It absolutely did. Without the absence of that historical charge, margins would be down, primarily due to an unfavorable sales mix. They are just selling a higher proportion of lower margin products in that specific segment right now.
Got it. Okay, moving quickly to commercial aircraft. Sales were $254 million, up 17%. Margins there were relatively flat, increasing just 50 basis points to 15.2%.
The top-line growth is strong there, boosted by Moog's pricing power and increased volume on major production programs like the Boeing 787 and Airbus A350.
Right, plus a robust aftermarket.
Yeah, but the margin story here is heavily masked by those tariff refunds again. Without the refund and factoring in the absence of the non-core product line sale from last year, the underlying margin in commercial aircraft would have actually contracted due to inflation and supply chain friction.
Okay, which brings us to the segment that completely blew away my expectations. The industrial segment.
This is the best part of the report.
It's crazy. They reported $282 million in sales, an 18% increase. But the adjusted operating margin here absolutely skyrocketed by 630 basis points to a staggering 19.9%.
Huge jump.
I mean, in a legacy aerospace and defense earnings report, the most fascinating growth vector is actually tied to the tech sector.
Yeah?
Management specifically cited surging demand for data center cooling pumps. So walk me through the actual mechanics here. Why is an aerospace defense contractor suddenly becoming a critical player in AI infrastructure?
It is honestly one of the most interesting pivots in industrial manufacturing right now, and it all comes down to thermal physics.
Okay, physics, let's hear it.
So the transition to AI requires massive clusters of advanced GPUs. These chips process vast amounts of data, and in doing so, they generate an immense, unprecedented amount of heat.
Right, they get incredibly hot.
Traditional data centers use HVAC systems to just blow cold air over the server racks. But with high-density AI clusters, air cooling has reached its physical limits. Air simply cannot absorb and carry heat away fast enough to prevent these new chips from basically melting down.
Wow, so the data center industry is basically being forced to adopt liquid cooling, like pumping specialized coolants directly to the chip or entirely immersing the servers.
Exactly. But bringing thousands of gallons of liquid into a data center filled with billions of dollars of electronics introduces a catastrophic risk, right? Leaks.
Oh yeah, water and billions of dollars in servers do not mix.
Right. You cannot use a standard industrial pump from, like, a water treatment plant. You need zero defect, ultra-reliable fluid controls that can handle extreme pressures and continuous operation without failure.
And who has decades of experience engineering fluid controls that absolutely cannot fail under extreme pressure?
The exact companies building hydraulic actuators for fighter jets and spacecraft.
That is so cool.
The engineering DNA is nearly identical. Moog has taken its core competency, moving liquids with extreme precision and reliability in the harshest environments imaginable, and they applied it directly to a booming new commercial market.
Makes total sense.
Yeah, they are supplying the critical pumps and manifolds required for these high-density AI server farms.
And that perfectly explains the margin explosion. When you are selling a mission-critical component to a tech giant building a multi-billion-dollar AI data center, you have immense pricing power.
Oh, absolutely.
The margin on a specialized liquid cooling pump is clearly exceptional, pushing that segment's operating profit to nearly 20%. And it sounds like this infrastructure build-out is spilling over into Moog's other industrial verticals too, like energy and medical, giving them incredible volume leverage.
It is a textbook example of a secondary beneficiary in a secular megatrend. Everyone focuses on the companies designing the chips, right?
NVIDIA, AMD, yeah.
Right. But the companies building the physical infrastructure required to keep those chips from literally catching fire are quietly reaping massive rewards.
But, reporting strong sales and expanding margins is only half the battle. If you are an investor, you know that accounting profit doesn't mean much if it doesn't convert to cash.
Cash is king.
Exactly. You
Yeah.
can't pay down debt or fund dividends with adjusted EPS. So Moog reported free cash flow of $133 million for the quarter. What stands out to me is their conversion rate. They reported a 111% conversion rate on adjusted net earnings.
A conversion rate over 100% is the absolute gold standard for earnings quality.
Yeah.
It means that for every single dollar of adjusted net income they reported on the income statement, they actually generated $1.11 in cold, hard cash.
How does a company generate more cash than its reported profit, though?
By heavily optimizing their working capital, they are basically collecting money from their customers faster than they are paying their suppliers, and they are managing their inventory aggressively.
Yeah.
It proves that the 15% revenue growth isn't just, sitting in a warehouse as unsold inventory or tied up in unpaid invoices. It is flowing directly into their bank account.
And regarding their future visibility, Moog's 12-month backlog surged 23% to $3.3 billion.
Which is massive.
Yeah, that provides a massive cushion for 2027 and 2028. Let's talk about management's role in this, actually. CEO Pat Roche dedicated significant commentary to their winning formula of innovation and operational excellence.
Right.
Specifically, they repeatedly highlighted their 80-20 capabilities approach to simplifying operations.
The 80-20 principle, or Pareto principle, is super common in business theory, but it is notoriously painful to execute in heavy manufacturing.
Why is that?
Well, it involves acknowledging that 80% of your revenue and profit comes from just 20% of your products.
Right.
Conversely, it means you are wasting a massive amount of factory floor space, engineering talent, and supply chain resources on the 80% of your product catalog that only generates 20% of your value.
So the capability approach means they're actively shedding low-margin product lines.
Yeah.
It's not just about efficiency, it's about making hard choices, right?
That.
It means telling legacy customers, hey, we are no longer going to manufacture this highly custom, low-volume valve for you, so they can free up that assembly line to rapidly ramp up manufacturing capacity for something vastly more profitable, like, those data center cooling pumps.
That is exactly the mechanism at play, and shedding those product lines requires restructuring. Which brings us back to how they are deploying that $133 million in free cash flow.
Right. They took a charge for this.
Yep. If you look at the adjusted earnings reconciliation, management took a $7 million charge this quarter explicitly for simplification initiatives.
So they are basically spending cash today to reorganize the factory floors and streamline the business.
Yes. They are utilizing their strong cash generation to self-fund this internal restructuring. They are taking the financial hit on the chin right now and rightfully excluding it from adjusted earnings since it's a structural cost, not an operating cost, just to lean up the business.
That makes a lot of sense.
They also highlighted successes from this approach globally, noting their Baguio operations in the Philippines won awards for environmental stewardship, and they are rolling out a new training center model designed to onboard manufacturing talent much faster.
So it points to a management team that is really focused on structural margin expansion for the next 3 years, rather than just juicing the current quarter.
Exactly.
So the setup looks incredibly strong. Fiscal 26 guidance was raised significantly across both sales and EPS. A $3.3 billion backlog gives them a clear multi-year runway, free cash flow is exceptional, and they are successfully pivoting aerospace tech into the AI sector.
That's a great narrative.
But responsible analysis requires looking at what could break this thesis. We have to dive into the notable risks management flagged in the forward-looking statements. The first major risk is supply chain constraints and inflationary impacts on raw materials.
Right, and while consumer inflation has cooled in many areas, heavy manufacturing operates in a totally different reality.
Very true.
Aerospace and defense rely on highly specialized, heavily regulated materials. Think advanced titanium alloys, specialized composites, and military-grade electronics.
You can't just buy that on Amazon.
No, you cannot just switch suppliers if prices go up. The certification process takes years. So if their raw material costs spike or a single supplier faces a bottleneck, it directly impacts their ability to deliver against that $3.3 billion backlog.
Wow. Okay, the second major risk is their heavy reliance on government contracts. When we reviewed the segment breakdown, space and defense combined with military aircraft made up nearly 52% of Moog's total revenue for the quarter.
Which means more than half of their business carries stroke of a pen risk.
Right.
They are highly subject to defense budget cycles, continuing resolutions in Congress where funding gets frozen, or outright program terminations. We literally just discussed the 360 basis point charge they took last year in military aircraft due to a canceled development effort.
Yeah, that's a real danger.
Government contracts provide massive steady volume, but a sudden policy shift or a budget standoff in Washington can instantly erase hundreds of millions of dollars in projected revenue.
And that transitions directly into the third major risk they highlighted. geopolitical conditions, and trade restrictions.
Yeah.
We spent the first half of this deep dive unpacking how a $30 million refund from the International Emergency Economic Powers Act tariffs was like the primary driver of their massive margin expansion this quarter.
The irony there is completely inescapable.
It really is.
The very mechanism that provided this quarter's massive financial tailwind tariffs and international trade actions is rightly listed as a primary existential risk to their business model.
Right.
Global trade restrictions disrupt supply chains. While winning a refund on past tariffs is a nice boost today, the actual imposition of new tariffs going forward would severely impact their cost of goods sold.
Because they buy parts from everywhere.
Exactly. Moog relies on a global supply chain to build complex machinery. An escalating trade war would compress their margins and heavily delay product deliveries.
It is a stark reminder to investors that what the government gives via a one-time refund, it can easily take away through new trade policies. The underlying core business is undoubtedly strengthening, but the headline EPS number requires heavy context.
Always look under the hood.
Exactly. So here is the final strategic question you need to ponder as you look at this stock. As data center cooling demands continue to accelerate and power density requirements push tech giants toward advanced liquid solutions, how long until traditional aerospace and industrial companies like Moog start being valued by the market as legacy defense contractors and start being priced as backdoor infrastructure plays for the AI revolution? Make sure you follow the show for your daily deep dive into the earnings reports moving the markets.